Shifting focus and welcoming on board Ms. Vibha Padalkar. She is the Managing Director and CEO at HDFC Life, joining us to talk to us about how the business is panning out and, more importantly, what lies ahead. Vibha, hi. Thank you so much for making time and speaking with us. Good morning. Wanted to begin by asking you with respect to the outlook on the APE growth, because in FY23 you did manage to clock a growth of 27%, but there was also that push that came in on account of tax changes towards the end of the year. As we look into FY24, what's the expectation of APE growth?
Hi, thank you for having me on your show. I just wanted to clarify one point. Even before the tax changes, we were trending in very much on track in the 17-18% kind of a zone, which is also in line with our aspiration and what we have demonstrated, doubling on every metric over a 4-year period. So we were on track. Yes, the uplift to the 27% that you mentioned was because of the sunsetting of tax. Another point I want to make on that point before I move to the outlook is that what is not fully perhaps also understood is that even below 5 lakhs and all our categories grew at least 50% in the month of March. So some of it was tax, but a lot of it was also perhaps just the demand coming back post the pandemic. Now, in terms of onto the outlook, a lot of analysts were perhaps attributing disproportionate amount of correlation between tax and the reason for insurance. And clearly, that is not the only reason why people buy insurance. And that's exactly how, at least at HDFC Life, our numbers have been panning out, whether it's in the month of April or in the month of May, and hopefully as we end this month of June, and sequentially growing faster. So starting off with about 7-8%, moving on to 10% growth, and hopefully June is better than what the other 2 months have been. Also, the number of policies, which has also been our focus, that has grown. And has grown by double digits in the month of May. So insurance as such is growing, as well as the quality of that growth is good in terms of holistically across all our offerings, as well as away from only the top 10 cities and moving into tier 2 and 3 towns.
So Vibha, as you gear up for, doing business in this regime of lower tax benefits or none, what is going to be the strategy, not today, tomorrow, but say next 3 to 5 years from now? Where is it that you're going to go aggressive in your business?
It's going to be a combination of ring fencing what we have today. So the core of why are we an insurer, why are we a life insurer will remain in terms of one or more of the risks of mortality, which is dying prematurely, morbidity, which is falling sick, and longevity, which is outliving one's savings. So it will always remain core to one or more of these objectives. But what you will see, Aisha, is that product innovation is bound to happen. HDFC Life is known as a product innovator, and almost every blockbuster product in line with changing socio-economic needs and in line with changing demographic profile of our nation, we will continue to bring those kind of products to the market. And if composite insurance were to come through, then that opens up even more possibilities and opportunities to bring very differentiated products and hence risk management for the average Indian.
Consciously also shift to lower tickets, and I'm purely asking in the backdrop of acquisition of Exide Life?
It will be a combination. And so the mix might be a shade lower, both as a combination of what's happened on the tax front for the sector, as well as acquisition of Exide Life. However, Exide Life typically has been between 8 to 10% of our of any metric, whether top line or bottom line or embedded value and so on. So it's not going to be disproportionate to meaningfully change at a company level. Even without Exide Life, our focus has been on how do we penetrate deeper into tier 2 and 3. And what is noteworthy is that our new business number of policies has now crossed 70% of non-top 10. So that has been a meaningful milestone that we have managed to reach and will continue to. So there will be various cuts of top 10 versus tier 2 and 3, older people versus millennials, and so on, and triangulating amongst these 3 different objectives of risk transfer.
Yeah, and Vibha, you talked about the factors that was underappreciated by the market, and one such factor is the partnership with HDFC Bank, and that could be a key enabler going forward. And there's also this expectation that the counter share with HDFC Bank can increase to 70% versus 55% that we have been seeing of late. What's the timeline of that? What's your expectation of how this partnership can help your business?
So actually, we've been in partnership for a very long time. I think that the nature of the partnership is very imminent for it to become just a partnership as a distributor and within the group company to becoming our parent. So really, it is a cementing and a culmination of that partnership into having a parent-child subsidiary. And as has been articulated by senior management of HDFC Bank, that's how they see it already in terms of a parent-child relationship, and how can the sum of the parts post-merger, this merger that is imminent, how the sum of the parts can be much larger by having a lot more of cross-sell opportunities, product innovation across the HDFC Bank group, and so on. So a lot that can be done in this space, and work is underway on that.
Could you help us get a bit more details in terms of, what these synergies could be in terms of numbers? If you can help us with some more specifics.
Yeah, sure. For example, today there would be a primary focus, supposing there's a new relationship at the bank on pitching banking products and banking solutions. However, the intention now is to say, post the banking solutions, that do you have a group a life cover? Do you have your employee superannuation and gratuity? Who covers that? And HDFC Life can cover it. Do you have some of the other solutions that we have in the NPS and pension space? So it's really end-to-end holistic. Similarly, in terms of focus in other subsidiaries of the bank. So it will be moving from being a bank in a box to HDFC Bank Group in a box. I think that will be the focus, and all of these are affording customers, and perhaps the penetration levels, as articulated by the management of the bank, can certainly start moving up very meaningfully. Whether it's 20% or 40% in terms of penetration, we'll have to see. But the opportunity, as they have articulated, is very meaningful.
Vibha, all that you've talked about, your vision for HDFC Life and the growth channels in the next 2 to 5 years, they're obviously going to come at a cost. And I'm guessing there will be a humongous cost involved when it comes to technology as well, right? Would it be fair to assume that you will have to sacrifice a little bit on the margins then?
For the longest possible time, HDFC Life has self-funded, except when we did an acquisition. And when you look at the profits that our back book generates, last year in FY23, our back book profits grew by 27%, which means that the profits are nicely unwinding from the policies that we sold last year before that, and 10 years before that. Right? That is what will fund growth in terms of new business strain. What I've articulated in the past also, that we have embarked on a very ambitious technology transformation project called Project Inspire. The outlay is something that I have quantified of being having already spent 50 crores last year and 200 crores more to go. So that's something that's already factored in terms of our margin outlook. And yes, there will always be pressures on margins, but we have to eke efficiencies out of our existing business and our back book to be able to fund some of that. Another point to the earlier question on HDFC Bank, and because it's related to the margin question, see, today we are at almost every HDFC Bank branch. Our people are there wherever HDFC Bank is desirous of selling insurance to its customers. Now, our counter share, if that goes up by another, say, 15% points, then that itself will mean an upliftment in margins, because I already largely have the fixed costs. So that leverage will start coming through as that goes up. So there are many such things. Also, in terms of many of our other relationships on bancassurance, as well as other partners, they are somewhat at the beginning of those relationships. A lot of them, whether it is a Yes Bank or a IDFC First or an India Post Payment Bank or a Bandhan Bank, and counting, many such, would mean that early relationship means we have already invested, we already have our feet on street trained, but that uplift should come in as the relationship matures. So some of that, which is our existing relationships and back book, should fund some of these investments that we have to continue making.
So give me a working number or a range, Vibha. What can we expect in terms of margins from you?
I'll answer this in two parts. If the tax change had not happened, the margins would have gone up. No question about it. Given that the tax change has happened and it is taking a little bit more time, while HDFC Life has fared in the first 2 months 2x or 3x, depending on versus private sector or overall industry, we have fared on every metric, whether it is in terms of new business growth, whether it's in terms of group growth, or whether it's in terms of number of policies or even protection. We have done well versus sector. However, it is lower than the typical run rate. However, we are carrying the costs of a full-fledged run rate of typically maybe 17-18%. So against that, we are trending as of now at like I've guided somewhere around mid-teens. So naturally, there will be pressure on margins only because of the removal of taxation. But if you take a slightly longer term view over the next year or so, once this year is out of the way, the upward trajectory on margins will continue to happen.
Sure. Vibha, I also wanted to understand from you with respect to the VNB growth or the value of new business growth. Are you expecting it to accelerate as we head into the second half of the year? And if yes, is it likely to be between the 15 to 20% range, or will it be in the mid-teen kind of levels that we have been seeing, 13, 14, 15%?
On a full year basis, as of now, the visibility that we have is that VNB growth will be very much in line with top line growth, and top line growth on the retail front, I have guided to mid-teens, right? So that's where it is. Now, the second half is likely to grow faster than the first half. And first half, like I said, first quarter, we have seen already the first 2 months trending at about 10%, just about double-digit growth, right? But that should go up. So just mathematically, if second half is going to be faster than first half and margins are more or less going to be held because of what I explained that has happened on the tax front, that would mean that second half growth will be higher and hence VNB growth will be higher. However, margins will be fairly at similar levels.
Okay, so margins at similar level, but VNB growth is expected to be better in the second half of the year. I just wanted to come back to a point
just one point on that I think is relevant at this point in time is that we've been talking about retail so far, but we've been doing exceptionally well on our group business, including credit life business. And that last year has trended close to 50% kind of a growth and across every marquee bank, NBFC, small finance bank, and so on. So that should be much higher levels of growth than what has been impacted in the retail segment due to tax.
Okay, so the group business is also doing well and it's making up for any loss, if at all, with respect to those tax changes that we have seen in the retail segment. Vibha, I wanted to come back to the point that you were, talking about that growth has been double-digit in the month of May, but give us a bit more color in terms of the various breakups as to which product segment is seeing more traction. And as we are tracking the month of June, is that double-digit growth accelerating? Is it plateauing? How's June panned out? Because we're just 5 days away from the month close.
What we're happy about is that even the above 5 lakhs is not zero. While there's a degrowth versus last year that had the tax benefits, it is still quite a respectable composition overall. The sweet spot seems to be in the range of 2.5 lakhs to 5 lakhs, which not surprisingly has grown upwards of 40% for us even in these months, right? So for many channels. So it appears that grassroots level connect somewhat hard way, I must admit, because it is focusing on more and more lives than just the ticket size. So a little bit more legwork that needs to be done in having a lot more conversations. But clearly that seems to be, like I said, the spot that is seeing demand. Another area that is doing well is on protection. And this is both retail protection as well as credit life. I've already talked about credit life, so I'll focus on retail protection. So the retail protection, and this is in the public domain in terms of the sum assured. And if you look at the sum assured, our sum assured on the retail side in the first 2 months has grown by 50%. Now, some of this admittedly is base effect, but even if you were to streamline the base effect, we have grown, and we have grown 2x the sector. In a way, all works out wherein the conversation now are a little bit more deeper as well as wider, taking admittedly a little bit more time. Also, there has been some front ending in the month of March, and perhaps people don't have as much disposable savings, but that will build up. That's a matter of time, another quarter or so before we are back on track. So to answer your question or to summarize that, growth is coming back in all segments and in all categories except the above 5 lakhs, while we are seeing business coming in and including higher ticket sizes, but that has been slow. But everything else is looking up and growing holistically.
Vibha, what would you like to tell your shareholders? Because after the budget, the taxation changes from those 457 odd levels, your stock has seen a massive recovery. But a lot lies ahead as well. Any message that you may have?
Absolutely. Insurance, we're talking about a long-term business, right? It is, and when you triangulate that, let's just cut out some of the noise. A few things here. First of all, on tax. The Nielsen report and many other reports show that tax is now perhaps the 8th or 9th reason for a middle-class individual to reason why they buy insurance. It used to be maybe amongst the top 3. Another aspect is that, yes, tax is an easier question for our sales folks to get an appointment. No doubt about that. But that's not the reason largely why people finally buy insurance. Second point is that money has to flow somewhere. Out of every 100 rupees, about 55 rupees flows into financial savings. And of that, about 17 to 18 flows into insurance and has been doing that through many, many cycles that we have seen over the past several years. So I have no reason to believe that that won't happen, because an average person will see, okay, I have this money, I've got this bonus, or I've sold this little business, or I've sold my house. Where do I invest it? And relative to other asset classes with similar risk appetite, we are at least 100 basis points better, and maybe slightly more if one is at a younger age. And the tax incident is into many, many years from now. And also, let's be realistic, tax on death is zero. So if you're looking at a long-term guarantee, say you bought a policy which is 15, 20, 25 years in terms of the term of the policy, it is possible that this starts becoming an estate planning tool rather than us being overly obsessed about tax. The other point is, let's again cut out the noise and the hoopla about tax and focus on fundamentals. Insurance penetration all-time, I won't say all-time low, but in terms of we ourselves as a sector we were above 4%, we are lower than that. So let's even get back to levels that we were as a sector. Second, penetration clearly in terms of protection gap, again 83%, again huge opportunity over there. Even if you look at in terms of health, out-of-pocket continues to be in the mid-60s. If you look at pension as a percentage of GDP, we are in low single digits. And this is when most of us, unless one is a government employee, we have next to no pension, and all of us are likely to live longer, perhaps easily 20 years post-retirement, and with where inflation is today. So when you just sit back and think as to look at all the macro indicators, and are we really saying we are maxed out? Last point, and it's an important one, is look at our per capita GDP. And it is very, very clear that the inflection point, especially in term and in protection-based products, one of the biggest indicators is what is your per capita GDP of the nation. And as that rises, and some of our neighboring countries are significantly higher, at least 5x higher, an average person will start worrying about, how do I protect what I have and how do I ring fence my family? So the hesitation that older people have in buying protection, I think that will start going down. Today, we don't struggle with millennials in terms of selling protection to them. So all of this means let's just, separate out the sound bites and the noise from, bottoms up fundamentals in terms of, what is the opportunity for the sector.
Vibha, absolutely. You make a very compelling case for the entire insurance space, and I think we'll have to go back and think whether we need to up our term insurance and life insurance or not. But thank you so much, Vibha, for joining us and talking to us about the entire sector and what lies ahead for HDFC Life.
Please pick up the call that's going to come to you now.
Thank you so much, Vibha. I'll wait for that call and have a discussion. But we'll let you go on that note. Thank you so much for making time for us.
Thank you, and congratulations on celebration of your anniversary of your channel.
Thank you so much, Vibha. Thank you for always supporting us.